welcome back, traders and investors. We have Jeffrey Hirsch on the line, and he is editor-in-chief of the Stock Traders Almanac. He's a 25-year Wall Street veteran. He's also the editor-in-chief of the Seasonal Sector Trades and Almanac Investor e-newsletter. He's going to tell us why the Dow will hit 38,820 and how you can profit from it. That's a bullish projection, Jeff. How you doing today?
I'm good. That's a long-term bullish projection. That is not short-term, but it is becoming much more plausible since I first made that long-term forecast in 2010 when everyone thought I was cuckoo.
Okay, and so are you just basing that on current valuations, rate of inflation, the information in the Stock Traders Almanac? What are you basing that on?
It is more of an inflation basis, which we don't have a whole lot of right now, but it's also a old historical pattern, a long-term pattern that was first uncovered by my illustrious father, mentor, and founder of the Stock Traders Almanac, Hirsch. Back in '76, after the '74 bottom, he put out a forecast about 500% moves following war and wartime inflation to take the Dow to 3420 by 1990. It didn't hit 3420 until 92, but the S&P made the 500% move by May 1990. So it's basically secular bull, secular bear market type of analysis, a pattern looking at what happened after World War I and World War II, when the market goes sideways with deep foreign military involvement like we had in Afghanistan and Iraq. And after the inflation kicks in from all the wartime spending and other endeavors like they had in the Depression and like we're having now with quantitative easing, and then once the inflation tapers off, you rally 500% over several years. So it's the secular bull. A lot of people think we've already begun the secular bull. I contend that we'll probably have another normal average size bear market sometime over the next few years before we take off from that sort of 82 or 1949 type of standpoint, or even like the post World War I 1921 to 23. That was a real short bull, but they're not the same size, but it's based upon that. So long-term 500% moves following wartime inflation.
Okay, and just going back to your dad, yeah. Now what did you say? He started this in what, 1976?
He started the Almanac in '66.
Wow.
When I was still cooking. I was born in May '66. He incorporated the Hirsch organization in February, and after working for several years with Sam Kozlow, our cousin, my godfather, at a place called Indicator Digest, which was a proving grounds, breeding grounds for newsletter writers, analysts, and the like, and came out, with this sort of epiphany to put all of the market's indicators, patterns, cycles in a calendar format so you could follow the market's, calendar along with your own, and put out the first edition in 1968 in the fall of '67, and it took off. It caught on like hotcakes pretty much. And, we kept developing it over the years. We added on several investment advisory newsletters and that sort of thing. And, I grew up in it. I used to work in the mailroom, labeling, packing books, shipping. I used to crunch numbers, do a lot of stuff back in the day with an adding machine and all the market lab pages from Barron's. So, then I joined full time in about fall of '89, and a couple years later converted all of the work over to Excel, and now we have it in. Go ahead. I'm sorry.
No, I mean that's just going back. I mean, well, first of all, I mean, for people that don't have it, and I mean it's great if you're a trader to get information. It's also great. I've gotten it for gifts for people. Just tell people what it is and all that information you have in there.
Well, I mean, first of all, stocktradersalmanac.com, you get the information. If you're a subscriber, you get a book for free every year. But it is a great gift, and that's what I used to pack up and ship out to a lot of the brokers and stuff over the years. We'd give it to client gifts. But in addition to, having a what we call a study page, right now I have it open to, for some reason I'm looking at August, of course, because it's coming up. page 74, it says why a 50% gain in the Dow is possible from its 2014 low to its 2015 high. This is the average 50% move from the midterm election year low to the pre-election year high, which is the best year of the 4-year cycle. And then on the right side page is a calendar. It's August 4th through the 10th with a place to write notes. It's got some inspirational quotes. It's got a couple of, market data points, like the first 9 trading days of August are historically weak. August is the worst Dow and S&P month. Harvesting made August the best Dow month from 1901 to 1951. So it's got reminders, places to make notes. I still use a pen and paper for some things. I find it takes things to memory a lot faster and stickier. So there's trading strategies, historical data, and then with our digital service, we convert that to apply it to what's going on in the present. So recently, we put out one of our market updates in an email alert and on the website for subscribers, saying partially one part of it was that 50% move, we're not expecting all of that this year. That's the average. Not sure we don't think we're going to get that full 50%. We'll get a nice, we had the best 3 quarters of the 4-year cycle coming up. The 4th quarter of the midterm year, that's October, through the first 2 quarters of the pre-election year, which would be through June of next year. However, with the taper and QE winding down, seen some sort of recent pattern where as soon as one of these programs is pulled, the plug's pulled on it, we tend to see a correction a month or 2 or so later. So with this thing winding down October, November, the Fed will make their announcement, potentially get that correction, in the first quarter. And January has gotten hit a lot recently. So it seems to be a month where there's a bit more profit taking than the old January effect. So another thing we keep track of is some of these indicators, they change. There used to be a September reverse barometer that just we moved it into the indicator graveyard, as we call it. And, the whole sell in May pattern, which is a big proponent of our work, we call it the best 6-month switching strategy, something Yale discovered and first published in 1986 in 87 Almanac, I believe, or it was the 86 Almanac. And there's this the sell in May. The old saying is the old British saw sell in May and go away and come on back on St. Leger's Day, which is the St. Leger Stakes thoroughbred race. It's the last final leg of the British Triple Crown, and it's basically the end of the summer season. Where if you've watched Downton Abbey or whatever, there's the London season is from like September through May, and then when it gets hot in London, if you've ever been there in the summer back in the days, everyone moved out of that swampy city up to the country. It's very much akin to the Memorial Day to Labor Day period that we're in right now, where volume sort of dries up. But the point being that the first half of the 20th century, as you heard me say, harvesting made August the best Dow month from 1901 to 1951. The best 6 months, the sell in May, wasn't in existence because in the first half of the last century, this was a very agrarian society. There's a lot of farming going on. A good portion of the economy was driven by the sowing and the reaping and the harvesting of crops. And now that only 2% of the country, or less than 2%, actually farm, we've got this sort of summer vacation pattern where we see a lot of sideways action from May through October in the market, and that's where we've seen a lot of the major pullbacks.
Well, now you're talking. Now you're bringing in horse racing into this, so you definitely caught my attention. I mean, I know a lot of what is it? Buy Rosh Hashanah and sell Yom Kippur, and those different.
Other way around.
The other way around. Yeah, well, I got caught on it last year, so I'm switching it around next year. But no, that's really interesting. So. Is a lot of the data that you put in here, do you have it in Excel and it's pretty much predetermined, or are you always looking for new stuff?
Combination. It's been taken from Excel into a SQL Server database. We have software that we can query and change things, and we're looking at, instead of just the 4-year cycle, we've got this 8-year pattern. We're in the 6th year of a president's term. Next year is the 7th year. That's one of the new wrinkles we've added to the Almanac, where you can see the average pattern for a second term president's pre-election year. So we have the data going back to 1901. I've cross-checked it, triple cross-checked it. We're big proponents of Barron's. We take the half-hourly data right out of there every week, check it, make sure it's right. I have a little communication with the statistic people there. Sometimes I pick up an error. I'll let them know. Um, but the key is taking these seasonal patterns, these historical patterns for whether it's stocks, commodities, stock sectors, small caps, or, big, large caps, whatever it may be, because there's slightly different patterns for all of them, and seeing how it's setting up in the present. So right now, we've got a few sectors coming online for their bullish period in August. Biotech, for example, is one of them. It's got a great move about, I think it's like 20 some odd percent for past 15 years. Biotech is, let's see what that average is, 15.7% over the last 15 years from, mid-August to I think it's just about March. So what we do is we come in early. We look for what the fundamental situation is there, what the valuations of the we're looking at the iShares Nasdaq Biotech ETF, the IBB. It's Indian Boy. And then we look on the charts. We layer in, we like MACD a lot. We use the 817.9 for the buy side, the 1226.9 for the sell side, looking at some relative strength, some stochastics, and a couple moving averages, candlesticks, and pivot points. And we sort of see where it technically looks like there's a buy point. So we've got a buy on dip, position there where we're looking for it to come back, closer to that support level on the monthly pivot points, which is very close to the 50-day moving average. And, it's rallied a bit here, but we're looking for it to be a little patient and come back and pick it on a dip to support. So go ahead.
No, I was just going to say, you're kind of answering my next question already, because I said you got all this data in front of all this information, all this historical info. You're keeping Barron's honest and stuff. The next logical step would develop trading systems based on that information, and that what do you actually design? Or have programmers do stuff for you based on this information?
Well, my partner's a programmer, and we, this is what we do in the digital service. We put out specific trading and investing suggestions, ideas. We don't say recommendations anymore because you can't do that unless you're fully licensed. And I'm also running some funds. Just started with an interactive brokers account, and I will be completing the Series 65 at some point and sub-advising with other people. So we're putting this into play with what we've been doing for many years. And it's with sectors and ETFs and commodity correlated ETFs and stocks. Last year there was a copper trade. Copper makes a bottom in December because it's winter and construction season is at the low, and we picked up Southern Copper. It's like a 20, 25, 30% run depending upon where you get in and out, with your execution. But you correlate, you trade a highly correlated stock or ETF with the sector or underlying commodity or complex that you're tracking this seasonal pattern that sets up in the present for you, technically, fundamentally, and seasonally. And we also do stocks. October, as we remind you ad nauseum in the Almanac, is the best time to buy stocks. It's the best time to buy high tech, and especially high tech and small cap stocks. So every year in October, we're not of the belief that we have to suggest a new stock every month. We do it in clumps when we see an opportunity in the broad market. So October, after we get a nice dip, we'll put out a basket which we screen for fundamentally. Low valuations, good margins, nice, history of increase in revenues and earnings. Not too much upside and definitely not downside. We look for them with a little bit of momentum. We don't want to be chasing the big Mo stocks right away. And we look at them tactically and pick a buy point for small, mid, and large cap stocks in different sectors. And it's worked out quite well. I mean, you can go look at the portfolio, or some of the archives. There's also, if somebody wants to log in, take a 7-day trial. You can send me a note and I'll give you that link. It'd be hard to sort of ramble off on the.
Okay. And what about you short stocks at all?
Yeah, we do.
What's looking frothy? What's looking frothy to you?
Well, the froth has started coming off. We back in the April May period, we put out a few. I'll tell you one that worked out pretty well. A lot of them didn't go short on us. We covered a lot of them. The market didn't go down, and we had a buy stop on there at about 7% on some of them. But Bunge, which was sort of an ag play, and also materials. They're a big soybean crusher, BG. That behaved. We got a nice short move on that. That was done. Let's see, back in I think March, April, we put that out, and I know I was talking to a subscriber out at one of the money shows, and he, yeah, it was a March 20th short, and it was on failure at resistance with confirmation in the technical indicators I mentioned, or breaking through support with also a breakdown of confirmation in the indicators. We have it still on the portfolio. It's about a 7.5, almost an 8% gain. It's on hold right now with a stop in there at about 76 and a quarter. And yeah, that's a good example of,
Okay.
of a short.
All right, we've had Jeffrey Hirsch on. He's editor-in-chief of the Stock Traders Almanac, and I encourage everyone in the Benzinga pre-market prep options house chat room to check it out, take a look at it. Even though it's in the middle of the year, it'll still be worth your while to get the information for the remainder of the year. Jeff, this was great. I certainly hope you can find time again to come on.
Oh, I'd love to. This was fun. Thank you very much.
Okay, thank you.